Why do we use this indicator? Well, moving averages simplify our view of the market. If the EMA is pointing up and the price is moving above it, then prices are rising and we want to be buying in the anticipation of the price rising further. Likewise, if the EMA is pointing down and the price is moving below it, we want to be selling in anticipation of the prices falling. If the price is wavering either side of the EMA, it is more difficult to make any trading decision. Different traders swear by different moving averages. Usually a trader who uses a moving average will use more than one to show the trading direction and where to take the trade. Now, a moving average can act as support for the market price. This is when the price is above the moving average and comes back down to it, and the price may bounce off the moving average and then resume the trend. This has occurred in this chart, in the two locations where the price is circled. In the same way, the EMA can act as resistance. Resistance occurs when the price has difficulty breaking through a higher price level. If the majority of traders think the price is too high at a certain level, the sellers can take control and the price will fall. You can see this is where the price is circled in green. Now, even though the price traded above the red line, buyers were unable to sustain a movement upwards. We can say that the 20 EMA acted as resistance to the price rising. This support or resistance happens for two reasons. One, simply by chance based on probability. We could plot, say, a 47 period moving average on the chart, and by scrolling backwards easily identify points where the price bounced off it. This is because there are so many price points on a chart. This behavior is sure to happen here and there. 2. The same EMA is used by a lot of traders. If the traders have seen the price bounce off their EMAs before, they think other traders will again buy the market when the price returns to it. So they do too, and a lot of buyers means the price goes back up again. We use the 20 EMA because our research shows that this is the most popular moving average. The trading method we use. Now, we have a much simpler way of looking at the market than trying to make sense of every up and down movement by the price candles. In this chart, the currency is spiking up and down, but the EMA provides a smoother line, following behind the actual price movements. When the price changes direction, it crosses over the EMA because the red line reacts slowly to each price candle movement. To make a profit from Forex trading, we need to buy the market when traders think the price is good value. Then we sell the market when and if the prices move higher. This can happen over a period of minutes, hours, or even days. In this lesson, we use the direction of the EMA as an indicator of the direction of the market. When the EMA is pointing up, we assume it will go higher. When it is pointing down, we assume the market will move lower. This assumption is for the purpose of trading practice only and does not constitute a profitable method of trading itself. In this next part of the module, we're going to discuss trends and trend following. Now, assuming the market will continue in its current direction is called trend following, and is many traders' preferred method of trading, to go with the flow. If we buy the currency when the price rises above the 20 period EMA, we are using the software and charts to help our decision to open a trade. The actual movement of the currency is the determining factor in the decision-making process, not you or I, the traders. The entry is purely mechanical, without any discretion at the time of the trade. We can look back over the chart and see where the trades would have been opened had we been trading at the time. This chart shows where the price crossed the 20 EMA. Waiting for the candle to close before considering the price crossed can avoid many false signals. Although it is possible to make profit when the market is falling, in this example we focus on just the buying opportunities for the sake of simplicity. At point 1, the price crossed above the red line, a buying opportunity. At point 2, the price fell temporarily below. At point 3, the price fell below again and then recovered at point 4. At point 5, the price crossed down again. A cross of the red line is not always an indication that the price will move higher, but it is a simple trading rule that we can use for practice. Getting in the trend. The best place to buy the market using this method is to 1. Wait for the red line to be pointing up or at least starting to turn up. 2. Wait for the price to move below the red line. This can happen momentarily or for a few candles. Or 3. Enter the buy trade when the new candle opens above the line for the first time. This chart shows a good example of these conditions occurring. Now when we are trend following, we are not seeking to trade at the very start of a trend because we have no way of knowing that the price is about to start a trend upwards. In this example you can see the red line is pointing up after area 1. This tells us the price has upwards momentum. This is very important because of this momentum. We assume the price will go a little higher yet. At area 2, the price and the buyers are taking a break as they adjust this new higher price. The buying trend resumes after area 3 when the price closes above the 20 EMA. Now this is important. From the examples here and by looking at live charts, we can deduce that when the price moves a long way from the red line, it inevitably comes back again or the red line catches it up. So it follows that entering a buy trade a long way above the red line will probably not be successful, at least not straight away. Try to enter the trade reasonably close to the red line. If you think the price is too far away from it, simply wait for another opportunity. This chart shows an example of the new candle opening too far away from the red line. Unfortunately, the profit is gone already. What happens when the price doesn't retrace? Some trends happen quickly and some more slowly. The slower gradual trends are more likely to come back to the red line before proceeding upwards. The faster trends may move at such an angle that the price simply doesn't come back to the red line until the trend has been running for some time, as in this chart. In this case, unless you manage to enter the trade at point 1, there was nowhere to enter the trade until point 2. It is unlikely that after this time the trend will continue much further upwards. Obviously, the further the trend has already gone, the closer it is to the end. At this stage of the training, we have no way of knowing where that end is, except as time goes by it gets closer and closer, so the chance of a winning trade must be reduced. So if you see a chart like this, you should wait for another opportunity rather than taking the trade at point 2. In effect, the horse may have bolted.